John, it's good to see you. We've been trying to make sense of both this dual story in terms of the stock and then the company's performance at the same time. What do you think?
Well, Andrew, it's great to be here. Happy Lunar New Year to everybody. For us, the fourth quarter was obviously a bit challenging given the market backdrop. But the key really is last year we delivered for shareholders. We had earnings grow 8%. We grew our AUM 11%. We had $225 billion of inflows during the year. And we delivered to dividends and share buybacks more than $5 to shareholders. But the key really is in our business is performance. And across the board, in real estate and private equity, in credit and hedge funds, we delivered positive performance, basically in protected capital in a year, where the S&P was down 18%. And the key really is where you deploy capital. So for us, huge exposure in travel and travel-related businesses, in logistics, in our hedge fund area, in quant and macro investors, in energy and energy transition. And so for us, what really matters is, do we deliver for the customers? When we do that, they deliver more capital to us, and ultimately our shares will respond to that. That's why we have so much confidence about the future.
John, you started your career as a real estate man. We have another real estate man at the table. So I'm very curious sort of how you see it, both in terms of the Blackstone portfolio itself and even some of the larger trends right now.
Well, I think on real estate, and Barry obviously knows a lot about this business, I think what you have to do is not paint everything with the same brush. There's clearly a headwind from higher interest rates, which has led to higher cap rates or lower multiples, and that affects all real estate out there. And we've been adjusting that in our portfolio with higher cap rates. But then when you look within asset classes, it's really dramatic, the differences. If you look in the U.S. office market, vacancy, including subleasing, is today now north of 20%. And rents are going down, and that's a very challenged sector. For us, fortunately, U.S. traditional office is less than 2% of what we own. On the flip side, if you look at logistics, there globally, you've got vacancy running 1% to 3% in most of the major markets, rents still growing 10, 20%, and leases in place that are way below market. In our fourth quarter, we saw 65% releasing spreads. So again, where you deploy capital matters. For us, logistics is 40% of our global portfolio. Also, as you look forward, new supply is starting to come down because of the higher cost of capital. That's a tailwind for real estate. And the 10-year Treasury is backed up now down to below 3.5%. So it is a mixed picture, but we think if you invest in the right neighborhoods, you can have a very positive outcome.